Welcome, everyone. My name is John Jacobs, and on behalf of my co-founders at ETF BILD, welcome to another professional development seminar that we put together. This one is, I think, so timely. I'm very excited about it. ETFs and crypto, past, present, and future. I'm going to introduce our panel members, and I'll kind of give an overview, and we'll go from there. So the three panelists we have today are Rahul Sharma, David Laval, and Kristen Werza. And I'd like to then we're actually going to ask them to do a self-introduction because they can talk about themselves and their firm better than me, and then I'll kick things off. So let's start with you, Dave.
Sure, Dave Laval. I am the global head of ETFs at Grayscale Investments. Grayscale is the largest digital cryptocurrency and digital asset manager in the world. I think most notably, we have largely been recognized for our flagship product, GBTC, and uplisting it to become a spot ETF. But thrilled to be on the panel, excited to talk with Rahul and Kristen. I think we're going to have a good time today.
Great. Thanks, Dave. Rahul?
Hey, Rahul Sharma. I'm president and co-CEO at Index. You may know us as a global index provider. We build our own indexes as well as we specialize in custom indexes. And we're one of the leaders in the space globally when it comes to thematic indexing. We first built our initial suite of cryptocurrency indexes back in 2017. Those are simple market cap and equal weighted indices using data that we source from various exchanges that we thought were high quality exchanges and other data points as well. And we've expanded since then into very interesting multi-factor related cryptos, as well as indexes in the cryptocurrency ecosystem. So for example, equity focused indexes on cryptocurrency miners, blockchain, and others. Big picture, we've got about 150 ETFs tracking our indexes globally and a little bit over 30 billion US dollars.
Great. Thank you. Welcome. And Kristen.
Hi, I'm Kristen Mearswa. I'm the head of digital assets for FTSE Russell. And we've been in the crypto/digital asset space since 2019. We cover 400 digital assets and have over 100 indices up and running. And I would just say we're really excited about this space because it's new and it marries so well with our other asset classes, equity, fixed income, commodities, FX. With high conviction in the space. And again, it's just been really fun working in the space since 2019 with our partner, Digital Asset Research.
Great. Thank you very much. And welcome. So, this is so interesting because if you think about this, and we're all industry veterans, et cetera, when I say industry, I mean financial services, stocks and bonds, those commodities, those have been around forever, right? So this is a new asset class, but it is one of the fastest growing, if not the fastest growing asset class we've ever seen. I mean, the white paper written by Satoshi Nakamoto only came out in 2008 or 9 from the financial crisis, right? So and there wasn't a single crypto back then. It was just a white paper about blockchain that led to Bitcoin. I recall when Tyler and Cameron Winklevoss came into NASDAQ in 2015, and we agreed to support them as they wanted to launch the very first blockchain Bitcoin ETF, which went into the SEC, spent a huge amount of time in 2015, and it took until the Grayscale lawsuit to get the SEC to finally move on that. But to think how long it's taken, but on the other hand, look how short it's been, and now look where we are. I mean, and so when I discuss this at classes at Georgetown or other places or different parts of the industry, it's clear that crypto is important. It's here to stay. It's critical to Web 3.0, right? When we're looking at the latest version of how web and the internet is going to work and support and change the way people do businesses and meet, and et cetera. Can't do that without tokens. Can't do that without cryptos. So I'm just really thrilled that we're at this point where this industry is becoming so quickly, almost, I wouldn't use the word mature because they have a long way to go, but it's really, really interesting to watch. And I think the last 10 days in the markets have been really interesting because, you come out of the volatile jobs report, the markets go through these massive swings, and every day you're hearing, well, the S&P is up and NASDAQ's down or this and the other. the bond market's this, here's the treasury, Bitcoin did this, Ether did this, and you're hearing like it's just part of the normal thing. Let's report on cryptos as a normal part of the market. It's a part of asset allocation. It's a part of portfolio construction. It's a part of what investors and traders are looking for. I do want to throw out a couple of data points why I think it's so important, though, that we finally have the spot ETFs on obviously Bitcoin and now Ether is the second one, and we'll talk about what's next. Couple of points. I was at the Texas Blockchain Council in the fall of 2023, and what was so interesting was they had just done a survey across Texas, and they said a demographic of people 55 and older or 60 and over, I can't remember the exact number, 4% of them had a wallet and owned crypto, just 4%. But if you look at the under 35 group, it was like 55%. So there is a challenge to accessing this asset class, or there was a challenge, because if you wanted to buy crypto pre the spot ETFs and pre these products, et cetera, you're getting a wallet, you're getting a 16, digit password and all those kinds of things. And that is not what none of my peers are going to do that, right? It's just not going to happen. It's just very rare that that's going to happen. But now this is as simple as, oh, I got a brokerage account. There's all these firms out there. They're offering these products. I can invest very easily. And I think I'm going to ask you about that, but I think we're starting to see an untapped market of people who want exposure to cryptos finally feel comfortable investing in the market because of these products. And then I'll give just one fun truth point. So my son, who's now 33 and just gave us our first grandkid, he was a kid. He used to collect and trade magic cards, and I'll put one up here. So if it's close, these are magic cards, right? Magic the Gathering, and they're magic cards, and they're launched in '93. And there's billions of them out there, and the kids would trade them and play them all that stuff. It was a card game, right? So in 2006, a firm in China, in Japan, started an online exchange, Magic the Gathering online exchange. In 2010, this magic card trading platform pivoted to start trading Bitcoin. They named themselves Mt. Gox, and they turned in, and by 2014, they were trading 70% of all Bitcoin that was being traded online every day. And then, of course, we saw them completely fall apart. 800,000 Bitcoin were stolen. The company went bankrupt. Hundreds of thousands of investors lost hundreds and millions of dollars, et cetera. And again, that's the early days of this industry, which is not that long ago, where people didn't understand it, didn't have it. And now we're at a much more mature space, right? So, the caveat in there, always know who you're doing business with. I think buying financial assets from a trading card platform may not have been the best move. So I am very glad to see, very happy that I think we're at the point now where we have such a robust marketplace with all the bells and whistles and all the regulatory protections that we need today. And so I think it's going to open the door. So I'm really excited. So let's, my long, big introduction, let me switch and start asking you guys to weigh in. Very first question is, give us start at where we are. And Dave, I'll start with you only because you have products in the marketplace and where we are and where we're going. And are you starting to see adoption by, a wider audience than we saw before? So let me turn it over to you.
Sure. I mean, the ETF being approved, the Bitcoin ETFs being approved and entering the market was absolutely an inflection point that's undeniable for the entire market. And I will take that in three different buckets: asset management, the kind of financial supporting market, so to speak, and then the end investors. So for asset managers, obviously, I mean, this is critical to our business, but it's no secret that other very credible traditional finance players like BlackRock and Fidelity, really waded into the Bitcoin spot market. Again, giving credibility to the overall market, and really kind of validating the, opportunity, the investment opportunity. So there may have been opinions in the past that those asset managers had, especially BlackRock, maybe saying that they weren't sure where Bitcoin fit into, a financial portfolio, but obviously they certainly voted with their business. And when you take a look at the asset growth and you take a look at the inflows, I mean, we're 8 months and a day into the, spot Bitcoin ETPs being in market. We have more than 15 billion inflows. That's, we're 2/3 of the way through the year, and that's more than 3 times the largest 1-year inflow of any ETF ever in the history of ETFs. So we're talking about like massive adoption, and a real proof point that you're taking one of the most successful, financial innovations in the form of an ETF. And John, you were there day one, and, really applying it to another financial innovation and kind of, technology transformation in the form of Bitcoin and digital assets and kind of marrying them together. So certainly on the asset management side, it's a huge opportunity to leverage all of the access that you have to end investors, from the smallest retail investor to the largest institutions in the world. And we're seeing adoption across the board. From financial markets, more kind of generally, you have a massive ecosystem that had to come together to ensure that this was going to happen. Not the least of which were indexers, custodians, admin agents, market makers, liquidity providers, authorized participants. And there were several instances of kind of square peg, round hole situations that needed to be solved. And I think everyone quickly rushed after, the products came to market and talked about the flows, when really they glossed over the fact that everybody had to show up in the ETF ecosystem and solve a number of different problems. And they worked. They worked across the board. And that was really, really a proud moment as someone who's dedicated the past, decade and a half, 2 decades to the ETF market, to see that actually happen. And that was something that I think is really important to recognize. That has built the foundation to allow us to proceed and launch Ethereum ETFs and, future crypto ETPs with confidence. And the third is the end investor. And I think I, just mentioned, from the smallest retail investor to the largest institution in the world, and you hear people throw out numbers like 55 to 60 million Americans own crypto. Look, when state pensions start making allocations to these crypto ETPs, that number is going to astronomically grow, even though it's happening on behalf of those end clients in their retirement portfolios. But I think there's an access point discussion to be had. We haven't even begun to kind of address the advised market. I think Morgan Stanley was the first to kind of get over the hump to allow for crypto to be recommended by their advisory teams. And I think we're going to see more advisory wealth platforms to follow. This is just the beginning. So that 15 billion of inflows, I think, is just the tip of the iceberg. I'll pause there, but we are in a really, really sound foundation of where I think we can grow this market to go. We could debate what the next, crypto to come into an ETP is going to be, but I think, we're poised for tremendous growth in the decades to come.
Thanks, Dave. I really appreciate that. So Rahul, let's jump into the same topic, where we are and where we're going in growth. But also, you can have the unique, as Dave mentioned, the infrastructure of the financial services had to come together in order to make this happen. And you're right in the thick of it as an indexer. So why don't you, if you could share from that perspective and talk about the same thing.
Yeah, I think, to add to what Dave said, anytime you have a product that is now easily accessible with some safeguards in place that give a broader audience kind of the ability to invest, that's a big plus. But then when you also have the additional, more important piece of it where, it's adding value to a portfolio, then you have something that I think really has the potential to grow quite significantly. And I think the simple value addition that these types of products add is the diversifying aspect, right? From a correlation perspective. If you look at the correlations for cryptos versus equities, the S&P 500, aggregate bonds, and others, those correlations, they have swung from time to time, but they have generally tended to be quite low. Even this year to date, if you look at the correlations, they're fairly low versus equities and fixed income. So that's why people are looking at the space more closely. I think one other thing that is interesting to note is when we've gone into these areas in the past, the growth and the interest at first is huge, but it's oftentimes not a straight line, right? You'll get ebbs and flows and peaks and valleys. And I think a good example of that is if you look at the thematic space. We're one of the leaders in the thematic space globally, and there's sometimes huge amounts of interest in the space, but it's taken time to grow. And I think that's what you can expect here in the crypto space. Now, the solution we talk about from an indexing perspective is always data dependent. We had to come up with some solutions that were quite unique when we started building thematic indexes, because the revenue data, for example, to identify the amount of revenue that a company is generating for a specific theme just wasn't out there. So we had to create it ourselves. And it was similar when it came to these types of crypto indexes. And Kristen, of course, knows a great deal about this as well when it comes to the huge amounts of data that were out there in terms of, let's say, prices and other types of data. But you have to worry then about the quality of that data. How do you decide which exchanges to include in a cryptocurrency index? It's not as simple as, for example, an equity where you can choose which exchange you want to pull the prices from, and you have a legitimate traded exchange. You have these exchanges located globally with 24-hour trading coverage, for example. So there's all these types of rules that we as an index provider, and that Kristen, of course, as well, had to build in to identify, okay, how exactly are we going to target this opportunity? And for us, it really comes down to the quality of the data and ensuring that, the index that you build is only as good as the information that's going into it. So for us, we built a lot of data ourselves, but we have, in some cases, also partnered with firms that specialize in particular areas like cryptos, like ESG and others, to ensure that we're building the best index possible.
Right. Thanks. And you actually is the perfect transition, because Chris, I did want to ask you the things that after my 40 years on Wall Street, the things that really make markets work and protect investors are pretty much transparency and quality data, right? You can't make good decisions. You can't do anything without good quality data. So, talk about the data journey in this relatively new asset class that is now growing, as we both pointed out, by leaps and bounds.
Yeah. So there's so many aspects that we could go into. So I'm just going to touch on a couple of them. So at the London Stock Exchange, who is the parent company of FTSE Russell, our role is really to bring market infrastructure and transparent market infrastructure. So what we started with in 2019, when we started looking at digital assets, was as simple as assigning CDALs to the digital assets. Makes it a lot easier for everybody if I've got a master unique identifier. What am I actually trading here? Because these assets are not primarily listed on any exchange, it's an OTC market, it's a DeFi market, and they are listed on many centralized exchanges, but there's no consistency even with something like a ticker. Some exchanges don't even list Bitcoin as BTC. So you had to figure out okay, how do we de-risk trading this with something as simple as a CDAL? So we took care of that. Another thing that we did, which I think is foundational, was adding a taxonomy or a classification across the digital assets. And I can't say this enough, the questions we got 5 years ago was, why do you need so many cryptocurrencies? If we've got Bitcoin, why do I need Ethereum? But when we would show people this classification system and that Bitcoin is a standard monetary protocol and Ethereum is a smart contracts platform play, that really helped them understand that the protocols in general have different use cases and purposes, but people need to see that on paper, see a classification system that's very consistent. And I'll just add that that's how Dave and I have been working together on the FTSE Grayscale sector products. This asset class is just beginning, but those are foundational things that we need to do as a community so people can understand, how do I add this to my portfolio, just like you would with equity sectors, right? You may have a play on where interest rates going, so that makes me want to invest in a certain sector. So that was important. And then what Rahul was saying about exchanges and back to Mt. Gox, something that we've been doing since 2019 is vetting the actual exchanges themselves. There's hundreds and hundreds of exchanges out there that we could get data from. But today we're only using 8 for our benchmark assets. So we cover 400 assets, about 60 of them are benchmark because we vet not only the exchanges, but the assets themselves. But we're looking for the things that we know that our end clients, the asset managers, the consultants, the traders all need, and that's to trade on these centralized venues that have great KYC, AML. They have enough volume. They've got market surveillance software put in place on their platforms. That kind of thing is what we're looking for and evaluating every quarter. And then I just mentioned that we also vet the assets themselves. So we're making sure that the assets are robust enough and would be appropriate to be in an index, a passive index. And so that means things like, are they liquid? One of the things I think has also been really fun working with this asset class is looking at developer activity. So these protocols, anyone can launch one, right? You can copy, they're open source. You could copy the Bitcoin protocol yourself and just run it and then walk away. And again, they're not primarily listed assets, so they don't delist either. So what we do is monitor the activity from the developers. Are people looking at the security of the network, ensuring that the code doesn't have bugs? Are they improving it? And this is all open source data available on GitHub. So anyone can go see like how many developers are actually participating in the network. And again, this one, I just think it's so interesting because it's different from equity and other asset classes where you've got a company who's ensuring that, it's doing what it needs to do. So I think the big takeaway I'd say for anyone on this webinar is to just know there's really interesting data that's out there and fully transparent. And that's what's so great about this asset class is you can see exactly what's happening and who's engaging with the protocols themselves. So we may not have a balance sheet, but there's tons of other data that the community can use to evaluate the health of a particular digital asset. I'll stop there because I could go on forever about
No, that's great. And
great data.
you brought up 2 points much more elegantly than I brought up when I was talking about the growth of this market. So how critical it is that you're vetting both the underlying crypto and you're vetting the exchange that it's on with. And that's important. That's why so many individuals are lost when they're trying to step into this marketplace. I can't do that. How do I do that? And they just walk away. So that's one really critical point you mentioned. And the second point is, I thought that was really important, is when you talked about, Ether, Ethereum, it's great for smart contracts. Bitcoin is for something else. These are not interchangeable, all used for the same thing. As Web 3.0 moves forward. And one of the things that I always use a diagram when I talk about this in class is, if you put a big circle up and say that's fintech, and then you put a smaller circle and you put down blockchain, which is within fintech, and then you put inside there, you put down crypto, and then you put in a smaller circle of Bitcoin. They're not all interchangeable. And the blockchain technology, distributed ledger technology, is going to be, and is already, people have no idea how involved it is in the plumbing of Wall Street and every other part of the business world today. So, and one of the best manifestations of that is to be able to look at a token or look at a crypto and see how that is the end product. So anyway, they jump in there and given that background, where are we going? Where else would we go?
Well, I think to that point, I always point back to GLD coming to market. Again, another inflection point for commodity-based ETPs. And I'll never forget how disgruntled the gold bugs were, because they were basically saying, well, if I don't have my gold in the form of jewelry or bullion in my vault, then it's not my gold. It's not, I don't have access over it. But the funny thing that happened after GLD came to market is it created kind of a bull case scenario for investing in gold, both in the ETF wrapper and then also for the actual bullion. And so I think we're going to see the same thing as it pertains to, Bitcoin or Ethereum. And I think it's going to kind of elevate the profile of the conversation of the utility of these cryptos and where they fit into a client's portfolio, because the conversation is going to become more ubiquitous. And I think historically, John, you and I were in that meeting together at NASDAQ when the Winklevoss twins were there. And I think you and I probably both wish we bought more Bitcoin when they were making their case for the investment merit of it. But what I would say is that historically, pre-ETF uplisting or pre-ETF coming to market, there was a sense of career risk for, an advisor to incorporate, crypto into one of their clients' portfolios because the risk reward was too high. And so despite the fact that wealth management platforms weren't permitting advisors to incorporate crypto into their practices, even telling somebody, look, I know you can't do this here, but go, get yourself 1% allocation to Bitcoin was career risk. I think that career risk is now inverting for the advisors in the sense that if they don't have a view on crypto, they will have career risk. So there's, 30 trillion in assets, on these wealth management platforms. There's, 80 trillion of wealth that's going to transfer. The next generation or 2 generations from now are going to have a very different view on wealth advice and on crypto. And I think if, look, I'm not suggesting that crypto belongs in every single client's portfolio. That's not the case. But what I am suggesting is that as an advisor, you have to have done the homework to have an opinion on what your strategy is around crypto. And once again, this ETFs coming to market are a real inflection point. It's something that's going to really catapult the conversation around where crypto fits in a client's portfolio, how to think about it, how to debate it. And I think that's a really exciting point in time. I mean, we've gone so fast in the first 8 months of having these products to market. And we thought that, it's going to be a much longer road to get Ethereum ETPs to market. And then all of a sudden we, had a very fast sprint to bring them to market. So to make a prediction on what's next is going to be very difficult. But I certainly think that we're going to borrow from traditional, finance and the kind of maturation of the ETF market in traditional assets will also happen with crypto. And we're going to see a number of more single asset products, and then also certainly some index-based and diversified products that, Kristen was alluding to.
Yeah, that's a great point. And use that exact point to transition to talk about the indexes. So going back in time, I remember when, we launched the Qs 25 years ago, it was, it opened up the world to a bunch of people who didn't know which NASDAQ stock to buy, but they knew they wanted to participate, but didn't know exactly how. And so why not? I just buy a basket. I'll just track an index. An index is safer. I feel much more comfortable, et cetera. And that led to the opening of a whole slew of index products and everything else. So, so let's talk specifically indexes, thematics, non-thematics, and where do you think we're going with that?
Yeah, I think what Dave mentioned about GLD is a perfect segue into this topic, because I think GLD launched 20 years ago this fall, was it? Mm-hmm. You had GLD, then you had IAU, and then from an index provider perspective, you had in 2006, I think it was 2006, GDX, and then a few years later, GDXJ, which were gold miners and junior gold miners. So that opened up the space and kind of democratized it for people who are looking to get access to the area and didn't know how to start. That's come up a few times before. Kristen's mentioned it as well. In terms of an index provider doing a lot of the legwork, identifying the companies that are eligible for inclusion, high quality companies. In the thematic space, we've done that quite a lot over the years. I think good examples of that from our perspective would be artificial intelligence or robotics, or even blockchain type companies. Investors have interest and they might be able to identify 1 or 2 names that they hear about in the news, but how do they actually get exposure to the entire blockchain space or the artificial intelligence space when you have companies globally that are providing, a huge amount of revenue to their bottom lines based on these areas? So, from our perspective, we look at this GBT conversion, the other launches as a kind of watershed moment that is going to power, from an index provider perspective, access to the entire space. Because as you also mentioned, John, it's about a lot more than just the coins themselves. It's about their use cases and what they're doing that are different. And I think people haven't looked into that much. Dave mentioned that advisors need to start kind of getting up to speed in this area because the use cases are very different. But as an index provider, one of the things that we can do is provide a lot of the legwork and do the research to identify, for example, the companies that are active and how they're differentiated in the blockchain space or the mining space, and put that in a nice high-quality index wrapper that then creates exposure through various traded vehicles for the end investor, whether that's a retail investor, a pension fund, an RIA, or an institution.
Absolutely. And it all comes back to data. So, Kristen, what's interesting is we talked about a lot of points here. I remember, because I'm more if you remember, before we had the internet, and then we have the internet. At the beginning, everyone said, oh, I've got to own the internet, or I got to own the web. What did that mean? Are you owning the hardware? Are you owning the network companies? Or you're owning the retails? Or you're working B2B? And it was all a big mess. And it took a lot of time and energy and people doing the data analytics, understanding of breaking this apart. You guys track 400 digital assets. So, it's more than we say crypto, but that's a whole ecosystem. It's miners and it's the computer manufacturers and it's this and this and the data centers and so on. So talk a little bit about the how you guys are looking at the entire ecosystem.
Yeah, so it's not a set it and forget it with the 400 assets. So every quarter we're looking through and running liquidity tests and seeing what are other assets may be out there. And there's just a couple names I'll just throw out because we talk so much about Bitcoin and Ethereum, but Arbitrum is another smart contracts platform that kind of feels like it came out of nowhere, although the market cap has risen quite quickly. So it's our job as the data providers to be monitoring that, ensuring, hey, if there's an asset that's up and coming and looking quite healthy, let's get it into the universe. And then, of course, it depends on whatever index objective you have. Will that name end up in that index or not? But the indices are only as good as the underlying data. You can kind of think of this like these ICOs, initial coin offerings, happen, but there's no centralized place where anybody would know exactly what's happening. So we're looking at sources with our partner, Digital Asset Research, X/Twitter, Discord channels. We're looking at the exchanges that we work with. They often will post things, but it's not a requirement. So it's a tricky space where there's multiple data sources out there, but the best thing we can do is lean on quant data if we can. So things like market cap and liquidity and how many exchanges is this asset now being listed on. That's a great barometer for how healthy it is, and then pulling it into the universe. So that's one aspect that we've been looking at. The other thing I just wanted to touch on is the 24/7 environment that we're working in. You'll hear people say, what is the true price of Bitcoin? And the answer really depends on how you're aggregating or what pricing model you're pulling together to get that price and at what time. So it's just like FX. If you think about that, right? Like I can trade with any one of you, pounds for dollars. You can do it at the airport and probably not get the best execution. You can do it through your bank. There's all different ways to trade it. And so this space is so interesting because it trades a little bit more like FX, but then back to the original question you were asking, Dave, about are the ETFs kind of leading the market in terms of price discovery for these assets now? Yes, maybe. We'll see. So, it's just something else to think about, and why this is an ETF panel, but why we think about ETFs being such a great way to get exposure is you can leave that to the professionals, right? So you've got teams and teams of people who are figuring all this out and deciding what is the best way for us to strike a NAV for these products and ensure that it's fair for you. The full transparency on the rules and what goes into it. You can data query any of this and see what's happened to kind of value your holding in whatever digital asset you're looking at. And all the other things that we didn't talk about that are so useful is once you've got in the ETF wrapper, then advisors have an easier time showing total portfolio holdings to their clients. They can run better risk metrics on it if they can see it all in one place. So, I think we all know why the ETF wrapper is so user friendly. But I can't emphasize enough that the professionals are doing a great job with ensuring you're getting the best exposure that you can.
You made a great point. The 24/7 point is one that I'm glad you brought up, because And so for as long as I've been involved in financial services, there's always been talk, oh, we have 24-hour trading of equities. No, we're not going to have 24-hour trading of equities because most people, equities tend to trade most liquidity during the home hours of the company, right? Because that's where the news is going to be. That's where development's going to be, et cetera. So, the rare times you're going to trade a U.S. equity in the middle of the night, it's a one-off. I know it's not perfect, but the point is, but that is not the case with FX. That is not the case with commodities. There is no home market, right, for news and for developments and things like that. So what's my personal opinion is, whatever you guys weigh on this, is that the development of the ETFs and then the options and the futures and all the other products on it are going to create that where the most liquidity is. And that's primarily right now going to be in the US Euro market time zones, right? That's where we're going to see most trading, most activity, and therefore you'll end up with it's a self-fulfilling circle. You get most data, most price reporting. So I do think that although these are 24/7 asset classes by definition, I do think that you'll see, and please let me know if you think I'm wrong, but that most liquidity is happening starting in Europe and ending in the close of the U.S. market. Would that be accurate or not?
Yeah, I would just say that the issuers that are bringing the products to market and the indexers who are ensuring the transparency and high quality kind of data or NAV strike, so to speak, are going to be really critical components to ensuring that every user of the ETP is kind of engaging with that product with a high degree of confidence. And I think we're very quick to always talk about the investment merits of exchange traded products, but all of us recognize that there are tremendous risk transfer vehicles as well that can be used for capital markets participants or institutions that are looking to have exposure to an asset class or exposure to a particular index. And Bitcoin is no different. Ethereum is no different. And so as that flywheel gets going, where more and more users are utilizing the exchange traded product for both investment purposes and exposure purposes, it's back to that self-fulfilling prophecy of the liquidity profile of those products kind of increasing. Now, I always like to say that not every ETF issuer is created equally, and not every ETF is created equally, and not every kind of indexer is created equally. And when you're talking about an asset class that is somewhat nascent, and you're starting to talk about the reality of this 24-hour trading, creating indexes on products that are not trading during the market hours of the ETP is not something that is foreign to us and that we can't tackle. But the reality is, when you have an asset class where you can't just take the closing cross price of the primary listing venue to snap the NAV of that particular exposure, and you have to be more creative with the methodology to ensure that you're having a precise exposure that the marketplace can rely upon and can engage with confidence, you start getting into some nuances that are a little complex for your average retail investor, which is why it's a wonderful opportunity for the exchange traded product to be the tool upon which financial advisors and individual investors can rely upon. And so, know who you're investing with, go to their websites, talk to their sales teams, make sure you're engaging with someone who has a high degree of credibility and experience with that asset class. And I think that offers a tremendous amount of protection, to avoid kind of engaging in a marketplace directly.
All right, which is why, which you couldn't do any of that with Mt. Gox in the early days, right? There was no one to talk to. There was no one to vet this whole thing. So before I ask another question, Raul, Kristen, do you guys want to weigh in? Right.
Kristen, do you have any thoughts? You want to go first if you do?
No, I'm all right.
Okay.
I would just add one thing I quickly add, John, is I completely agree with you that you're going to see, the majority of volume probably in the US and Europe. We've seen something very similar in the ETF space. I mean, we have clients globally, but we have a lot of clients that prefer the UCITS wrapper due to its regulation, due to its transparency, due to its safety. And we also see, very interestingly enough, a lot of clients in markets like Israel and in Korea even though they have very vibrant, locally traded ETF markets, continuing to actually allocate a significant amount of their assets and their trading volume to U.S. exchanges too. So I wouldn't be surprised at all if what you're suggesting takes place as well in this space as well.
Right. So to kind of switch gears, I'm going to ask you guys, what surprised you? What surprised you about where we are today versus what you thought just a year ago, right? But also wanted you guys to comment, because I had spoken to a few people who, and this again goes back to the early days of ETFs in general, with spiders and Qs and diamonds and a few of these other products way back in the day, where institutions and other market participants are actually using these vehicles as a short-term cash equitization strategy or optimization strategy, right? So rather than sometimes sitting in a cash position, if you think, and Raul goes back to your point about how there's not a large correlation. So if you think equities are not the place to be right now, but you think there's a great opportunity in Bitcoin or Ether or some of these other places, the ETF is a very easy way just to rotate in some cash to that, to take advantage of that opportunity. So I've heard that is happening to a certain extent, which is, I think, another sign of maturation of the market. But so what surprised you guys of where we are today versus where, like you thought a year ago? Right.
Who wants to go first? I want to dive in. I'll dive in. I'm going to go a long-term surprise and a short-term surprise. The short-term surprise was the path with which we came to regulatory permission to launch Ethereum spot ETPs. That was quite a sprint and a little bit of a shock when I think the entirety of the market thought that we were going to have, be faced with denials from the SEC. I like to think that the market had kind of proven the case that there was really no strong opportunity to deny those products in the face of some of the successes that had, previously and really recently been experienced with, the Bitcoin ETPs coming to market. So that's kind of the short-term surprise was Ethereum products coming to market. The longer-term surprise for me is just generally how swiftly we have kind of advanced the conversation around digital assets being a critical component in clients' portfolios. And this is something that I think, Chris and I have talked about this, Rahul and I have talked about this, John, you and I have talked about this. We've been in the market where for a very long time and have essentially lived as real evangelists for the exchange traded product and the value that it has brought to investors. And I think about being in the late 90s down on the floor of the American Stock Exchange where ETFs kind of were born and thinking these things really make sense. I am getting an incredibly similar feeling right now about digital assets as I did in the late 90s or kind of the turn into the early 2000s about how much ETPs make sense and how much crypto makes sense as a component in a client's portfolio. The concept of these things is no longer being considered just vaporware or snake oil, so to speak, and recognizing that, oh, wow, each one of these tokens is really just like an entrepreneurial new piece of software that is coming to market. And just like pets.com, might not have won and Amazon.com did in the late 90s when we were considering these, IPOs versus ICOs, nobody really knew what the winner was going to be, but we all recognized that the internet was going to be something that was really, really valuable to the broad investor base and to us as consumers. And I think that the first application of that transformative technology, the internet, for me, was email and making the world a much smaller place to be able to communicate. And so that first application of the internet was really, really valuable to me and it resonated with me. And so I was a believer in it. The issue with, digital assets largely is the first application of it, Bitcoin as a digital currency, for most people is kind of useless. And so they dismissed the entirety of this transformational technology. And I think people are now educating themselves and recognizing that this is a little bit bigger than just Bitcoin and that we have a new wave of software and a new wave of technology that is coming upon us. And they're much more open-minded to it after kind of initially dismissing the technology. So the broad adoption and the swiftness of this kind of shift in attitude is something that I think has been really, really enlightening and surprising and exciting.
Yeah. Before I turn to Chris and answer the same question, I will say I think Bitcoin also is not just useless to a lot of people, but it has a very dark history, right? It has a very troubled past from everything from the Silk Road and doing all those illegal activities and things like that. So, I think that, the defense mechanisms of like the US government or the Euro government looking at these products was like, first thing is, what? You want me to allow you guys to do Bitcoin and put it in the hands of my grandmother? That kind of stuff. So anyway, Kristen, to you, what were the biggest surprises from a year ago?
So, just how resilient the digital asset / crypto marketplace is. You hear this concept of crypto winters and they come and go, but it just seems like this industry is really good at reinventing, picking themselves up, keep going, and kind of staying true to the idea of some of these decentralized protocols being integrated into our daily lives. So that has been great. And then I will say, I like how playful the industry is. A lot of what they're doing is just putting more fun names around things, like, an airdrop is just sort of like a dividend payment, but not, so everything is like they're pulling vocabulary and from the TradFi world and just making it a bit more fun. But if you know how to translate it, you're like, oh, I know what that is. We've been doing that forever. So I'd say don't get discouraged if you hear a vocabulary word that you're like, well, that's over my head. I'm like, it probably isn't. Just Google it. You'll be fine. So that the reinvention, the thing that has actually also surprised me is, without regulatory clarity, it's really hard to think about a world in the US where we'll be incorporating staking in some of these ETPs in the future. So that's that reward yield that you get through the consensus mechanism of proof of stake protocols, where it's being highly adopted outside the US. So that's something we've been working on for clients outside the US, where there's clarity so they can move forward. Mm-hmm. I think when yields come down here in general in the US, then we'll have a chance to revisit it and push it forward. And that helps everyone understand a bit more about the intrinsic value of some of these protocols, where you can hold on to them and earn a bit of yield by participating in the network. In a very simple way, right? Just like you can buy and hold a security and earn dividend yield that way. So that's been a surprise that it's taken a little bit longer here in the US, but I do think that when the US decides to rally around something and there's clarity, the players in the market move fast. So I can tell you, people are already figuring that out for themselves. The asset managers, like, how are we going to handle this when it gets approved? And then the other term I hear a lot is there's still alpha in the beta. So I would just say, if you're not already somehow getting exposure, think about it, because there is alpha in the beta. It's not too late. This is so early. There's so much innovation that's still happening that, I would encourage people, like, don't feel like you missed out, because you haven't at all. There's so much going on. And just, embrace it. And like Dave said, call your sales reps. There's people there who would love to talk to you about this. Okay, Rahul, we'll let you answer that one.
I think, Kristen, you and Dave covered the key things. The one last thing I'll say quickly is, how much additional room there is for innovation across the entire ecosystem. If I look at just even the Bitcoin mining space, the innovative things that are happening there, the efficiencies that are happening there, not only with miners, but with, for example, renewable energy and power. I mean, John, you spoke earlier about having different circles. Any circle you look at in this ecosystem, there are really exciting things happening, and we're really still in the early stages.
That's great. So this has been so positive so far, because we're all excited about this asset class developments. Let me ask you another question, and this time we'll start with you, Rahul. Is what keeps you up at night?
Well, a lot of these things that we see, not only in the crypto space, but in investing and asset managers in general, are very news cycle driven and press driven. So the things that keep me up at night are the downsides, as Donald Rumsfeld used to say, the unknown unknowns that you can't think about, but that could easily, create a red flag moment that really makes not only individual investors or institutions or pension funds, but even maybe regulators start taking a look at something, maybe just not because there's something there, but because something has hit the news cycle that just causes people concern. I think that's more of a short-term thing. But that would be the only thing in my mind that would really, I wouldn't say keep me up at night, but that when I wake up at night, I might think about before going back to sleep.
Okay. And Kristen?
Well, I'm going to turn it into a positive, just how much work there is to do. There's so many things to get done. People are asking for very, very creative things. So it's more a time thing. Like, can we get it all done fast enough to capture that investment opportunity? Because there's so many things that people could be doing right now with the space. So it's just, more work.
Dave?
I would say that I've got like a known unknown, which is just the regulatory landscape, and I think that everyone's probably immediately saying that that's a negative, and I actually really don't know. It's just so unknown, and the tides have turned so quickly on the regulatory front in so many instances over the past 18 months that I think that unknown is going to be something that's going to be very hard to kind of manage to and manage businesses to. And so that's something that we pay a lot of attention to. And as more and more seems to be kind of, politicized down in DC, I think this is going to be an interesting topic that I think historically had been considered partisan. And then, some were saying it's becoming bipartisan. And now I like the term of calling it nonpartisan, which is probably the most bullish. And so that's going to put us in a unique seat, in a unique spot to make sure that we're able to take advantage of everything that's going to be offered to us from a regulatory, perspective. Clarity would be a wonderful goal. I don't think that we're going to get there very quickly, but I think an openness is something that I'm anticipating and excited about.
That's great. This has been a great conversation. I'm going to ask you each in a second to just final thoughts. But what I love about this whole topic and everything, even what keeps you up at night, it's all about opportunity. And one thing I'll say after all these years in financial services is no industry is more innovative. No industry likes to solve problems more. If you think about where we were to start and then these products and market, all the little steps that had to be taken. So every single time, and that's the way these markets are, you look for inefficiency, you make it efficient, and we move forward. And so I don't think there's any problems that we're able to solve here. It may not go as fast as we want because regulatory certainty, regulatory clarity is always one of the defining cogs in the process. But anyway, I still remain extremely bullish, like all of us. So first, last thoughts.
So what we've been kind of working under is this assumption that we're setting industry standards. It is a brand new asset class. And, whatever we put out there may not be exactly perfect to start, but we're getting things out there and iterating from there. So I would just say, if you don't see something from anyone in the ecosystem, ask them. They're probably working on it. They've got some sort of model behind the scenes that, they're like, we want to tweak this a little bit more. But I think a lot of people are willing to just kind of keep moving forward. Again, it's hard when there's not regulatory certainty and industry standards to figure out exactly what is the beginning and the end of the day. What pairs do we use? Like all these questions come up. So I think people will just move forward with what they have today, and it will keep evolving and getting better and better, and the bar will keep raising. But it's really fun. So dive in.
Dave, last words.
I think I would say the euphoria that has surrounded crypto more generally is attracting more and more people. And I happen to be at a firm that's been doing this for more than a decade. And there are firms that have dedicated a lot of time and energy to this. And then there are firms that have shown up very quickly. And if you want to educate yourself and you want to consider this as something that you want to incorporate into your portfolio, or you just want to learn more about, leverage the resources of firms that have been around for a while and have been doing this and have dedicated themselves to it. That's a wonderful place for you to get information, and it will either click and you will gain confidence and you will feel like you're engaging with a credible resource, or you won't. And I always encourage everybody to kind of educate themselves. But in this particular case, things have been moving so rapidly. Make sure you're partnering with someone who is dedicated to the asset class and has been around for a long time.
Great. And so final word to you, Will.
I would just echo the bullishness of everybody on this call, but I'll also say I've also been really struck time and time again in the ETF industry in general by the level of innovation that just comes out of the woodwork. So many times we've worked with not just existing clients, but a new phone call that we get inbound for something really unique that makes us just stop for a second and say, you know what, I've never really thought of something that way, but that is a really interesting potential idea. This has happened to us so many times, Dave and Kristen. I'm sure it's happened to you and John, you as well at NASDAQ and your previous positions as well, where this idea just comes out of somewhere and it turns into something just beautiful. So for everybody who's on this call, I'd say if you have an idea, reach out to Kristen, reach out to Dave, reach out to John, reach out to me, and let's see if we can turn it into something really interesting.
Perfect. Perfect way to end this conversation. Guys, you've done a phenomenal job. I thank you very, very much. I also want to thank Elise and Scott at Thompson Hine for making this all happen flawlessly, as they always do. And this will be posted and will be online, be available, etc. So again, thank you to my three panelists. You guys always make my job easier. And the other important thing is I always learn so much on these things. So I really do appreciate that. So anyway, so everyone enjoy the rest of your summer and back to school, everything else. I appreciate it. Thank you very much.
Thank you.
Thanks so much, John. Thanks, guys. Good seeing you all.